What's going on, guys? It's Blake with Trade Tracer. As always, none of this is financial advice. Always trade and invest at your own risk. All right, so we are back again with another weekend market analysis, and we just exited OPEX on Friday. So the previous video, I talked about the week before OPEX, where we oftentimes see quote unquote pivotal lows, and that's exactly what we saw right before we headed into OPEX week. And we actually wound up closing higher than we did on those pivotal lows that we put in on Friday the week before OPEX. Now, one thing to note here, and something that I think is of some significance, is that we put in new highs right here on the S&P on Thursday, December 17th, but those highs were not confirmed with MACD. So we put in new highs without MACD, which is bearish divergence, and could become a serious concern if we break below those pivotal lows that we put in the week before OPEX. So the lows that we put on December 11th on the S&P, the low was 363.26. If we close below that level, then this bearish divergence is something that we definitely need to respect and keep a close eye on. However, as long as the market holds trend, as long as price stays above the 10-day moving average, this bearish divergence doesn't really mean much. Now, we definitely need to reclaim price strength confirmation above Thursday's high. And if we do that, odds once again are going to be favored to run higher once again, especially if we get that MACD bullish crossover. But right now, not a great place to add new risk on the market. Now, this week is the week of Christmas, so we have a shortened week. We only are trading 3.5 days this week. And I'm told all of my members that regardless of where we are in the market, your trading year should be done. Your gains should be locked in. You should already know what kind of trading year you had. You should not be trying to press anything right now on the market, especially after putting in new highs without MACD. Now, I posted this chart on Twitter on Friday, and I bring this to your attention because, a lot of you think that I'm just a perma bull. I'm always long. I'm always, thinking the market's going to go higher. But that's with a reason. The higher time frames still suggest that we're going to go higher. Until the higher time frames say that we're not, then I'm going to get even more conservative and potentially even bearish and short the market. But until that happens, I'm going to stay long versus my stops. And people ask, well, where's your stop? Well, very simply, my stop is going to be below the pivotal lows that we put in on last week, the week before OPEX, that 363.26 on the S&P 500. If we close below this level on a daily time frame, this is price weakness confirmation, and the odds will begin to favor the shorts. So we could potentially come back and test this 50-day moving average right around that 354, 355 level. So if we break this level, keep an open mind that we could potentially come back and test even lower levels. Now, I'm not predicting that this will happen. We have to trade price, and right now price is still respecting trend, and I am going to respect that trend as well until price tells me otherwise. So my take right now, not a great area to add new risk. The year for your trading year should be done with already. Not the time to be pressing long, and keep an open mind. Keep an eye out for these pivotal lows that we put in the week before OPEX, and if we break that, then we're probably going to head lower. However, if we reclaim price strength confirmation above Thursday's high, then it wouldn't surprise me if we come back and test this upper trend line right around the 380 level. So keep an open mind, respect price, respect trend, and make sure that you're always trading with the odds in your corner. So that's all that I have for you guys today, and I will see you again on Monday.